Imagine this. The market is soaring. Investors are celebrating. Portfolios are glowing green. And then, boom! Overnight, everything crashes. Stocks plunge. Billion-dollar companies lose half their value. And regular people lose years of savings in just a few days. Scary, right? But here's the truth. Market crashes are not rare events. They happen again and again. And if you don't understand why they happen and how to survive them, you could become the next victim. Part 1. What is a stock market crash? So let's start simple. A stock market crash is a sudden, dramatic fall in stock prices, usually more than 20% in a very short time. Think of it like a financial earthquake. One day, everything feels stable. The next day, the ground shakes. Companies, banks, and even governments feel the shock. Crashes are usually triggered by fear. Fear spreads faster than wildfire. When investors panic, they all rush to sell at the same time. And when selling pressure explodes, prices collapse. Part 2. Famous crashes in history. Let me take you back in time. 1929. The Great Depression. The Dow Jones lost nearly 90% of its value. Yes, 90%. Imagine your $1,000 turning into just $1,000. 1987. Black Monday. In a single day, the market fell 22%. People woke up rich and went to bed broke. 2000. The dot-com bubble. Tech stocks went to the moon and then crashed back to earth. Companies with no profits, just hype, lost everything. 2008. The financial crisis. Banks collapsed. Housing collapsed. Lehman Brothers went bankrupt, and millions lost their jobs, homes, and retirement savings. Each time, it felt like the world was ending. But guess what? The market always came back. Not immediately, not painlessly, but eventually, it recovered. Part 3. Why do crashes happen? Here's the million-dollar question. Why does the market crash? There isn't one single reason. It's usually a deadly mix of factors. Overvaluation. When stocks are way overpriced, they're like a balloon filled with too much air. One tiny pin, and pop. Economic shocks. Wars, oil prices, pandemics. Anything that disrupts the economy can trigger panic. Bad lending practices. Like in 2008, when banks gave out risky loans, and the entire system collapsed. Investor psychology. This might be the biggest one. Greed pushes stocks up. Fear pulls them down. And when fear spreads, it's unstoppable. Part 4. What happens during a crash? Picture this. The market drops 5% in one day. News headlines scream, "Biggest drop since 2008." Investors panic. People log into their brokerage accounts and see red everywhere. Some sell immediately, thinking they're protecting themselves. Others freeze, too scared to act. The selling snowballs. A 5% drop becomes 10%. 10% becomes 20%. And suddenly, we're in a full-blown crash. Meanwhile, hedge funds and big players, they're waiting patiently. Because when you panic, they see opportunity. Part 5. How to survive a crash. Now, the most important part. What should you do when the market crashes? Here are a few golden rules. 1. Don't panic sell. History proves this. Those who panic lose the most. Those who stay calm recover. 2. Have an emergency fund. If you need cash immediately, you won't be forced to sell at a loss. 3. Diversify. Don't put all your money in one stock, one sector, or even one country. 4. Think long-term. If you're investing for 20, 30, 40 years, today's crash is just a speed bump. 5. Look for opportunities. When quality stocks fall 50%, that's not always a disaster. For smart investors, it's a discount. Part 6. The hidden opportunity in crashes. Here's something most people don't realize. Every crash has created millionaires. Think about it. The people who bought during the 2008 crash made fortunes over the next decade. The investors who picked up strong tech stocks after the dot-com crash are billionaires today. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." That is the ultimate rule of surviving crashes. Yes, it takes courage. Yes, it feels terrifying. But when everyone else is running away, that's often when the biggest opportunities appear. Conclusion. The market always rises again. So let's wrap this up. Market crashes are scary. They're painful. They test your patience and your emotions. But history is clear. Every crash, no matter how bad, eventually gives birth to the next bull market. The question is, will you be the one who panics or the one who stays calm, thinks long-term, and comes out richer on the other side? Because remember this, the market rewards patience, not panic. So next time you see the headlines screaming crash, take a deep breath, stay calm, and remember, this too shall pass.